What we're going to be looking at here are contingent liabilities as loss contingencies, and we're just going to be going through a basic example here and look at the guidelines on these loss contingencies here. So our example here is during 20X1 Corporation A was involved in a tax dispute here with the IRS, and it was probable that Corporation A will lose this dispute here and will have to pay the IRS between $1,600,000 and $2,800,000. That's the estimate that was made here by the tax attorneys. Now, after the 20X1 financial statements were issued here, the case was settled with the IRS for $2,400,000. Originally estimated between $1,600,000 and $2,800,000, but settled here for $2,400,000. So what amount, if any, should be reported as a liability for this contingency as of 12/31/20X1? Those would be the financial statements for this company here. So this is what we want to do. You have to lay this out in a timeline here. So this is our timeline here. So we're going to be looking here at during 20X1, there's a tax dispute here with the IRS here. So, and this is the key point here. It's probable that they will lose and have to pay between $1.6 million and $2.8 million here on this tax dispute. That's Corporation A. What would have to be reported as a contingent liability here on our financial statement date here on 12/31/20X1? And then the other key point here is that reporting and recording this liability here again on 2/5/20X2 here, this is when the financial statements were issued here, the financial statements for the year here 20X1 here. And then just to point out here, this case was settled here for $2.4 million on 3/1/20X2. That was the settlement date here with the IRS on this tax dispute here. So the settlement or the case was settled here after the financial statements were issued here and well after the year end or the financial statements date here for 20X1. So this is what we would look at here. This is the answer here. Because the case of litigation occurred before the date of the financial statements and because an unfavorable outcome is probable here, and reasonably estimatable here, you would report a loss and a liability here in 12/31/20X1 financial statement. So this is what we would do. And because it was probable here and we had a reasonable estimate on this loss here, we'd be reporting it here since it occurred here before our financial statement date here. So what we would do here is on our balance sheet, we'd have to record here a tax liability for this IRS litigation here and credit it for $1,600,000. And then we look at a loss liability, loss here on our income statement, again for this tax liability here. Debit that for $1.6 million. Well, why did we use $1.6 million here? Okay, so when no amount within the range is a better estimate here, the key is you use the low end of the range, you accrue it, in this case at $1.6 million here, and the high end of the range is disclosed here on our financial statements at $2,800,000. So we accrue it here on the low end of the range here, and we disclose it on our financial statements at the high end of the range because we didn't have any better estimate than that $1.6 million to $2.8 million here on this tax loss, and it was probable here. So let's go up and let's just look at go over our guidelines here now. Okay, so this is what we would our contingent liability guidelines here. A, two conditions must exist before a loss contingency is recorded. Number one here, if information prior to the issuance of the financial statements indicates that it's probable that a liability has been incurred at the date here of the financial statements here, and two, the amount of the loss can be reasonably estimated here. And the other condition B here, when some amount within the range appears at the time to be a better estimate than any other amount within the range, that amount is accrued here. But when no amount within the range is a better estimate than any other amount, the dollar amount at the low end of the range is accrued, and the dollar amount at the high end of the range here is disclosed on the financial statements. And then point C here. If the amount of the loss is uncertain here, the following disclosure in the notes is required here. Number 1, the nature of the contingency here. And number 2, an estimate of the possible loss or range of loss, or a statement that an estimate cannot be made here. And then let's just go down here and make a point on our litigation, claims, and assessments here. Now you consider the following factors, among others here, to determine whether to record a liability or for a pending or threatened litigation, and the actual or possible claims or assessments here. All right, so these are 3 points here that we have to consider here. Number 1, the time period in which the cause of action occurred. Number 2, the probability of an unfavorable outcome here. And number 3, the ability to make a reasonable estimate of the amount of the loss here. Now, to report a loss and a liability in the financial statements, the cause of the litigation must have occurred on or before the date here of our financial statements. So we've just gone over here our general guidelines here when we're dealing with these contingent liabilities here as loss contingencies here. So all right, so that sums that up.